Good morning. My name is Iftikhar Mahmood. I'm a dealing representative with Parvis Invest, and welcome to our Brick by Brick webinar. The goal of the Brick by Brick webinar is to make real estate investing feel approachable and easy to understand, and help you to learn how private real estate investing works, and what to look for in opportunities, how to think about risks and returns. It's really about building your knowledge over time, and so you can feel more confident in making decisions and growing your portfolio with clarity and purpose. Just to go over the disclaimer, this content is not limited to provide, it's not intended to provide and should not be relied upon for investment, tax, legal, or accounting advice. Nothing in any presentation shall be construed as a recommendation or offer to sell or solicitation of an offer to buy any securities. And without, actually, I'll give you a bit more information about Parvis. Parvis is an exempt market dealer. We help investors add private market opportunities to their portfolio. We perform independent due diligence to confirm the accuracy and completeness of information shared with investors, and we democratize the private markets for Canadian investors to build wealth. Today's guest is Centurion Asset Management, and with us we have Matt Barnes. Matt has been a long-time sales representative at, actually, what's your official title, Matt?
Director of Sales.
Sorry, Director of Sales.
Yes.
At Centurion, and he will be going through what Centurion brings to the marketplace here across Canada. And Matt, take it away. So this is your disclaiming information. I don't know if we want to go through that in detail, but we'll just put it up there.
This is really there just for information purposes, and is in no way and under no circumstances to be construed as an invitation to make an investment in Centurion. There's obviously risks involved with any sort of investments, and for everything we always say, look, please go to a financial advisor such as Iftikhar, obviously, who understands the private investment market quite well to get financial advice. And please note as well, past performance may not be repeated. And here we'll just quickly go over the Centurion Apartment REIT, the sector that we're in, and give you a bit of a sense of what we do on the operational side and some of the financial highlights and what the future looks like for the Centurion Apartment REIT as well. Quickly, the sector or the focus of the Centurion Apartment REIT is, as you can see here, is the Core Plus sector. And what that means is really there's the core. The hard, like the core type of investments are, I would say, look at it kind of the large, RBC downtown office tower type of building where it has, tenants locked in. It could be office, it could be, apartment, could be real, potentially even industrial. But the idea is, very well established tenants in place for extended periods of time. And the target return there is usually definitely on the lower end, mostly in income, plus some potential for some appreciation on the pure core side of like 5 to 7%. Centurion's focus is very much, as you can see here, is the Core Plus. So instead of being as a core mandate would be in just primary cities, we're in primary and secondary cities across Canada. And well, I'll say primary cities and secondary cities in Ontario and BC. Rest of the country just in the primary city. So I'll give you an example of that here in Ontario. What that means is obviously we don't have anything in the downtown core on the apartment side. What we do have are buildings out in Etobicoke, out in Scarborough, and down, say, southwestern Ontario. So southwestern Ontario would be considered the secondary market. Similar situation in BC. We don't have any apartments in the downtown core. That's not our focus. But we do have them out in, say, the Surrey, like Kelowna, say, would be a secondary market for us. The rest of the country, it would simply just be in, say, Alberta, we would just be in Edmonton and Calgary. In Quebec, even the largest rental market in Canada, our focus is purely in Montreal, the suburbs of Montreal as well, and up in Quebec City. So our focus is we want to be where people are, where the demand will be, where people want to live when they do come to Canada. And the idea is really provide some tax efficient income with some potential for growth on top of that. And our target return is 7 to 12%. And just quick look is you can see here is our focus are the B-class apartment buildings. So that can be, I say in a lot of ways, it can be the newer acquisitions we've been making are condo-like, a lot of amenities, very, very, I would say B-class is kind of middle income upper middle income type of properties. So it gives the amenities that people are looking for when they're renting, but it's not I would say not the Class A type of buildings, which are I would look at it, if you would look in the Toronto area, those would be the Yorkville type of properties, the very high end, A plus type of buildings. That's not our focus. That's not our market. We want to be in the more middle income type of focus for the portfolio. And here you can just see since inception of the apartment REIT, we've obviously grown quite significantly since our inception in August of 2009. And right now we stand at about 7.8 billion in AUM and just over 444 staff members. And I'll just say the Centurion apartment REIT continues to see opportunities and has continued to grow. And actually last year was our busiest year on the acquisition side, where we brought in about 2,200 units. And through our equity financing, which I'll go into it a little bit later in the presentation, we have another approximately 1,200 units coming into the portfolio over the next 12 to 18 months. And here just gives you a bit of a breakdown of the portfolio. And I always stress, look, the real estate, it is a real estate fund, and the primary focus is the apartment space here, which you can see is just over 81%. Second to that is the student housing, which is just under 12%. And we have that little sleeve of lending at 3.8%, which is our lending to developers. I'll always do stress, we do not develop ourselves, but we do lend to good developers that we have good relationships with the idea of obviously making an acquisition once that building's been completed. It's been a great way for us to get more properties into the portfolio in areas we want, and at a very high standard, very high quality from developers that we know very well. We do have a few properties in the US, but I'll stress the focus is Canada. 1.5% of our buildings are in the US. And then we do have a little sleeve of medical offices as well, which is, I'll say, a very opportunistic acquisition for us a couple of years ago, but that's something, if we get the right price, we would look to potentially sell. And you can see this, the breakdown of the portfolio. As I mentioned, in Ontario, BC, we are in the primary and secondary cities. And then the rest of the country, again, the focus is primary cities alone. Manitoba, just Winnipeg. You can see where we're clustered around, the north and south shore of Montreal, a few properties closer to the downtown core, then obviously up in Quebec City, a couple of properties in Dartmouth and Nova Scotia. And I do stress that focus is being in those larger population centers, and where we see with population growth coming from, that is almost entirely coming from permanent immigrants coming to Canada. It was temporary foreign workers and some international students, but more in the permanent residents coming to Canada. They're looking for obviously high quality housing, but at a more middle income type of price point. And the benefit of being in purpose-built rentals, I say, especially for people coming to Canada, is they have certainty of tenancy. They know that they can stay in this big property for 1 or 2 years, or even longer if need be, before they decide to jump into home ownership. So it gives them that sense that they can get into a nice building, well-maintained, well-run building in good locations, but know that they'll be able to stay there for a number of years before they decide to move on, before they need a bigger space for their family, whatever the situation may be. That's something that's you can't get that in, say, renting from the condo market as well. So being a purpose-built building, they have that certainty that they can stay in there for a number of years if need be. But if I just drop back to that slide, just quickly shows you the orange dots are where we have student housing. And we do always get questions about how the student housing is operating. It's doing extremely well for us. Our focus has always been 4-year universities with 10,000 plus students. And you can see here, Southwestern Ontario, so it's, Western University, we're very close to Western, and in Waterloo, very close to Waterloo, and Laurier. So we're in great locations. And then we have one property downtown Montreal, very close to Concordia. McGill does extremely well for us. And then property out in Calgary, then out in BC. And we actually do have one right downtown Toronto. That's the only property we have in the downtown core, but it's very close to Ryerson, or I guess now Metropolitan University. So that's been doing extremely well for us. No issues there, because the focus again is large 4-year universities.
So Matt, is that an area of growth in terms of the student housing residents that you have a certain number of buildings in your portfolio right now? Is that an area of growth?
We like the space quite a bit. We have 17 properties in the portfolio. it's not always easy. It just depends on the university and what's available. So we always want to have, larger properties that we can obviously own and operate, and that's not available in every city. Like there can be restrictions on what's going to be able to be built. So, and certain circumstances, the universities themselves are very effective at providing housing. So we're very selective, and I always look. Obviously, real estate's a location game. But especially for student housing, you want to be as close as possible to campus with the right amenities. And it's tough to get those in every location to get those type of properties. So we're always looking, but it's an area we would like to gain more. But we are very specific on what we're looking for, and that's not always available, and it's maybe not available at the right price.
I'm quite familiar with the universities both in London and in Waterloo because my kids went there, and there's a number of mom and pop type apartment buildings that are close to campus. Would that be the type of thing you guys might purchase to convert into student housing?
Setup for, say, apartment buildings is different than what you would normally see in student housing. And an example of that is some of our student housing units have 4, in some cases 5 bedrooms in there. It's extremely rare to find that in an apartment space and maybe outside of ultra high luxury type of properties. So the setup is different, and you got to have a certain amount of amenities that the students are looking for. And right. You also, 4 or 5 bedrooms have to have obviously a certain amount of washrooms and facilities for people living there. So it's
more purpose built than just the average apartment building.
Yeah. Okay. Obviously students live there, and we do see it actually in certain areas where the students are competing with call it local non-student population for some of the housing. But I find the stuff that's as close to campus as possible is really far more purpose-built for students.
Got it. Thanks.
Here's just a quick overview of the executive team at Centurion. And Greg Roman, the gentleman on the upper left, there is the founder of the fund. Been exceptional. Done an exceptional job building out the Centurion asset management and where the fund stands today. Greg has taken a bit of a step back. It is his company, and he's still very much aware of everything that's going on. But he did bring on John McKinley, our president and CEO, just over a year ago. And he brought on Paul Chin actually just about closer to a year and a half ago to help run the day-to-day. And also we brought on Carl Gomez, our chief economist of over 25 years. Sorry, he's our chief economist that joined us here in January. So we really built out the executive team, and very excited obviously to have them on board. They've been making some very being very astute on dealing with the current situation that we're working through. So it's been great to have them on board. And Robert, our Chief Compliance Officer and CFO, has been with us, I'll say more than 13, 14 years. And here just gives you a quick overview of the apartment REIT. And one, gives you that, I would say, real exposure to the apartment sector here in Canada without the stock market volatility. Stock markets can move away from the fundamentals of any business, and just due to what's going on in the world. So a lot of different factors can push, say, investments into publicly traded REITs. But the benefit of, I would say, looking or being invested in the Centurion apartment REIT, being a private REIT, is that it's based far more off of the fundamentals of the space. It has some obviously good growth potential. As I always look at Canada, we're going to be a bit slow in building, and population growth continues to be quite strong. So we're not, I'll say, not too worried about being overbuilt. And then you can see this is something that's available in all of your accounts in Canada. RSP, RIF, TFSA, as you can see there, but LIF, LIRA, non-registered money as well. And for non-registered money, there's the benefit of it being very tax efficient distributions. Last year, it was the return of capital component of the distributions was 95%. I'll just say return of capital is a tax treatment. The distributions are fully funded and paid up by the operations of the REIT. It's just the benefit of it. And since it's something like Iftikhar, if you're looking to invest, could explain in further detail what the return of capital benefit is for investors in non-registered money.
Right.
And here you just get a good idea of what our target markets are. And obviously we want to be in the growing areas, want to be where people actually want to live. I do stress it's going to be primary and secondary markets, but we talk about being in the cities, the larger population centers, but I do stress really more so removed from the downtown core, especially in the Toronto area and especially in Vancouver. Even somewhere like Montreal, we have a couple properties closer to the downtown, but most of them would be out in the suburbs, like north and south shore of the Montreal area. And again, it is the Class B type of buildings that we're looking for, that kind of middle income type of properties. And as we see, housing in Canada is not very cheap. We'll say it that way. So a lot of people are looking for accommodation in well-run, well-maintained properties, again, with that certainty of tenancy. So that gives them the flexibility of stay longer if need be. And the benefit of what we're doing with this Centurion Apartment REIT is we're really focused on buying properties in the right locations and being more, obviously demand is going to be strong. And with us, we also have, I will say, second to none on the operations side. Exceptional operations team, making sure that the buildings are leased up, making sure the buildings are attractive places to live, clean, safe, well maintained, at the same time, making sure that they're good investments as well. So it really is providing much needed housing in Canada, because we do need as much as we can get, but again, at a very efficient level. We're very effective on the operations side as well. So it's a great place to live, and actually at the same time, a great investment.
Matt, just a question. We have clients all the time talking about downsizing and going from a house to, say, a condo. And some of them even talk about, well, maybe I won't even buy, a condo. Maybe I'll rent. Do you find a demand from, a growing demand from seniors or people who are retiring, looking to, downsize and rent and live off some of that income that they've made off their primary homes?
Well, you'll see, we definitely have seniors in our buildings, and it does make their life a lot easier, especially if they want to go travel. They want to go to Florida for 3 months of the year, or just go take those trips that they've been looking for. This is easy living. They have zero worries about upkeep and maintenance. So this is, someone who is definitely in that retirement phase, this is hands off. Great option for someone who's not going to be there all the time and doesn't want the headaches, obviously, that come with home ownership. Right. There's an issue with the plumbing, you call the superintendent. There's no need to cut the grass. It does make life a lot easier. I would say, especially for someone who's made that transition from, say, home ownership and wants to have more freedom, more flexibility. Absolutely. And here just shows you the returns of the fund since inception. And our target return is 7 to 12%. So that's an income plus appreciation target. So a total return target. And you can see here we've had some great years. I'll just add out 2009 was a 4-month period. And then since then, except for last year, we've been pretty much within our target return. 2023 was a lower return of 6.5%. And then last year, we saw the lowest return that we've had in the fund since inception. And that was really, I guess, with any investment, it can go through a bit of a cycle. And as you can see, the REITs had a very strong run over the years. And we did see some weakness in the real estate space, in the rental space here in Canada. There's a bit of a pullback in demand, relatively still very strong though. Like if you look at our stabilized occupancy rate, as of year end, it was still 96.6%. So the buildings themselves are still operating at a very high level. And what was a bit of a pullback though was we saw a lot of say condominiums come on the market, which in all cases were from investors looking to rent those out, and those rents due to the market were priced very competitively. We didn't get into those type of bidding wars at all on rents, but we do manage them and I would say still a very strong job of getting our units leased up. But we are looking optimistically towards what we see, and going in rest of 2026 and 2027 and beyond. But I will say, return-wise for this year, I would expect the income, and maybe there's the potential for some appreciation later in the year. But what's been adding to a bit of the uncertainty is, I'll say, global events and what that means for inflation. So obviously some issues potentially with, say, oil driving inflation up, which can obviously mean interest rates go higher, and then at the same time potentially cap rates can maybe go up a little bit. That's the uncertainty. That's something we cannot control. But I will stress, what we can control is making the buildings as efficient as possible, making sure they're leased up, and doing a great job bringing on new acquisitions. But saying that, I know we'll expect returns with this year again of just just really the income component, and then potentially down the road as we do see demand continue to grow and as supply does become a little bit tighter, that we could see some appreciation in the NAV as well.
So a couple of things. So we went through a real rocky period in the public markets through COVID. So you can see that 2019 through to 2022, and Centurion more than held up its bargain of performing exceptionally well in those years. And then we had the heavy inflation years in 2023. Would you like to touch on that as well as the loss from last year a little bit?
Well, as you saw during COVID, things were managed extremely well. And I mean, the demand was still there. People were obviously still need somewhere to live, and immigration was still, people were still coming to Canada, but construction was slowed down greatly. So that kind of supply was lagging. And but going forward into 2023 and 2024, we still had, I would say, very respectable returns for investors. It just, I would say it was this year, or sorry, 2025 rather, was the year that, looking ahead, that expectations were a little bit dampened. Now, where we would see rent growth, we are still seeing rent growth on turnover of our units, and but not as strong as we would, initially expected to see. And that was working with our third-party appraiser, who comes in and evaluates our portfolio on a monthly basis and does a full portfolio review quarterly. So it's I would say very strong oversight, but again, we bring on high quality third-party appraiser for the portfolio. And at the same time, we have a majority independent board of trustees that does review all of the valuations. So I would say there's tremendous oversight. And I will add as well, you can always go to our website and then look at our financial documents. They're all available. No need to log in. Our financial statements, our offering memorandums, all the marketing materials that we have. You can see all the, the portfolio and webinars and updates from our executive team as well. So I would say I would second it on really on the transparency and how we value the entire portfolio.
So just to clarify then, so, rental income was strong year over year, but it was really this, your third-party appraiser who wrote down the value of the overall, assets under management, and then basically said that, we have to be realistic and say this is the true value at this point in time.
They were looking at it as, the year ahead, that their expectations for rent growth were decreased. So they didn't see that in the apartment sector performing quite as well. But I don't want to overstate that. Like that was a bigger component of bringing down, the NAV, the returns for the year. But we look at it, we still see this obviously as a very strong sector to be in. Something we'll get as with anything. Performance, things are a little bit cyclical. And I mean, I'd love it to go up, 13, 14% year after year, but that's just not, I would say, realistic for any investment. But we do see this as a bit of a trough, but we do see ourselves obviously getting out of this. And we're still growing. We still see, opportunity, definitely some strong opportunity in the apartment sector. And we're still making acquisitions.
Right.
So we're going to be bringing on more properties. So it's...
Sorry, I just to add to, so you did mention in 2026 the return will be more a function of the annual income. What is the current yield or the income, as a percentage?
Right now for the Class A investors, it's just over 4%. So 4.03%. And if you're dripping or reinvesting your distributions, the yield would be 4.25%.
Okay. So better than any GIC out there, essentially.
Very much. And I would say real tax benefits as well with the income stream. And we like showing this chart because it puts things into perspective where, yes, last year wasn't the greatest return, but also sees how the REITs performed throughout, say, times of big, uncertainty, to say the least, through European sovereign debt crises, stock market crashes, Brexit, U.S. elections, which are always exciting. And obviously, going through the whole COVID and wars, trade wars with the U.S., like the REIT itself has done an exceptional job of protecting investors. And I know if you look at the markets these days, everyone's talking about AI. We're not in the market to compete with anything like an AI investment, but we want to provide a steady income. Our target is always 7 to 12% with far less volatility than what you get out of the stock market. So I like to say it's a nice, boring investment. You give it time to work, and you'll be very happy over the longer term. That's for sure. But again, this shows you how it does during times of uncertainty. And you can see that from the starting point, we've done quite well versus, call it, the S&P TSX 60 and the S&P TSX Cap REIT. And this just shows you correlation versus the major ETFs that you could invest here in Canada: S&P 500, TSX 60, gold, Cap REIT. I won't go over all of them, but you can see the REIT being in the upper left-hand corner. It's what you want to have in your portfolio. It does show that it is truly a diversifier for your returns, for your investment. And you can see here, attractive returns with very low volatility. And again, it doesn't go with the public markets. Those can go up, they can go down, but the REIT is, again, very steady, very boring. And you can see there the very low correlation to even to the S&P TSX Cap REIT ETF, which is not purely apartment, which would, so that lower correlation does make a lot of sense. But you can see versus S&P 500, high yield bonds, like there's very low or negative correlation versus those other investments out there. So that is adding true diversification for your portfolio. And it is apartment buildings in and around major cities in Canada, where we do expect to see demand, obviously, to be consistent in the years ahead. And here we did, as I mentioned, consistent demand. We're still going to see strong immigration, still targeting 400,000 for permanent residents coming to Canada. And at the same time, we are seeing some initiatives coming from the government side to potentially make it cheaper and maybe speed things up. But we are relatively slow at getting things approved, getting things built in Canada. So it always is. It seems to be always a game of catching up. So I always say, look, things can be built a little bit faster. That'd be great. But I don't see that being meaningful. I don't see a meaningful change coming there. So I do say Canada will be a little bit slow. We'll be playing catch up on the housing supply side there.
So Matt, I mean, even in terms of immigration, the numbers have been tightened up quite a bit by the Carney government, and so one of the reasons Centurion has done well, I mean, the demand from the demand side is because of immigration. How do you see that playing out in the next couple of years in terms of the demand for your portfolio?
For us, the immigration is, we see mostly permanent residents coming to Canada. So those people are coming, those individuals are coming, with them solo, call it, and with with their family. But in a lot of cases, they do come here. They do have credentials. They do have, a university education or some qualifications where they are able to come here and get jobs, and do come with, financial assets, say cash, whatever it is. So we always look at, I'll say, making sure our tenants can afford the rent, making sure that they do have employment. So for us, we don't see it being much of an issue, because we found like a lot of permanent residents do again appreciate what being in a purpose-built rental means. So they don't have to say go into the condo and potentially have to move because the landlord sells it, or their son wants to move into the condo, whatever it is. So there is I would say, real benefit, but also like if we're seeing the population growth slow in Canada, there's no doubt about it, but that was a lot of temporary foreign workers, and they would say necessarily go into more, I say, the gray market. By that I mean condos where they're weren't looking at doing the, call it, due diligence on the tenants that we were doing,
right?
And you did hear, unfortunately, some undesirable circumstances where people were living in, I'll say, less desirable accommodation. Yeah. But that was where I think that was more for the impacting, where we're going to see that in those areas. Not the purpose built will be impacted by the decrease in temporary foreign workers. That I think will be more impacted versus what we're seeing is, I think it's like strong permanent resident immigration will be continuing to provide a lot of demand for what we do, especially where we're located. And I always do stress that if you're coming to Canada, you want obviously come for economic opportunity, a better life, and we're in the right locations. And here, this just shows you, it may be a little bit tough to see, but the U.S. the number is on the top, and Canada is on the bottom. And the U.S. market is obviously, I would say, far more cyclical in supply and demand. So people, and I use this example, people could say move down to Texas, they will drive prices up, but then the response from from the market is for developers to build, and they build quite fast.
So sorry,
And
what are
then
the scales here? So the left side versus the right, the bottom.
it's those are actually, it is a little bit tough to see. Let me just pull up my my PDF here. But those are multifamily vacancy rates. And the numbers for some reason are exceptionally small. But you can see the US one is roughly at 10%, and then kind of fluctuating around 10% where it starts on the left-hand side.
Right.
And then for the dark Canada line, it's about just under, I would say 3.3%, and it's gone up and obviously has come down. But it really does highlight the differences in vacancy rates in Canada versus the US. And you can see we're pretty consistent. I mean, it's gone a little bit higher, gone a little bit lower, but it's kind of moving in a very noticeable trend sideways versus the US.
The x-axis is just time, right? Like I think it's 1990 through to 2026 or so.
End of 25, yeah, 2025.
Okay.
So, and that's why we look at it. It's like the longer term. It is like a very stable industry, very stable investment to be looking at.
Right.
Because it's kind of within that range, and it's hard to see that really changing going forward. So unlike the US market, which call it more dynamic, so there's more volatility in the space.
Gotcha.
And this, I mentioned our operations sides. I won't go too in depth here, but it just highlights what we do to make sure that buildings are as effective as possible, or maybe I would say it managed as effectively as possible to keep down costs, but also at the same time, make sure that they're comfortable, safe, clean, well-run properties for our tenants. And there's a few interesting things here, but we do go, LED lighting, installation of pumps and makeup air units with variable frequency drives. You can see that's led to some significant savings in some of our projects. And building automation systems have led to up to 15% savings in gas consumption in a lot of our properties. And then here, tenants self-metering results in less water and electricity usage, which obviously makes sense if it's, there's no cost to the tenant. They're not too concerned about leaving the lights on or leaving air conditioning on or whatever the situation is. So that really changes things quite a bit. And we've done that, I think, in most of the portfolio. And then you can see water conservation, like just taken very seriously. Because water is one thing that the REIT itself would pay. That is one of the expenses. So it's been very effective on reducing that. And they've even spoken about, sensors on toilets to see if toilets are running. Just want to make sure, because you can kind of see what's happening where water's being wasted and needlessly being wasted. So we do, again, this is kind of a few examples of how we make sure that, again, the building is being run very efficiently, which is good investments, but at the same time, I always do stress that these are very attractive buildings for people to live in. And this gives you just a bit of a sense of the potential upside in the REIT. It's the rent to market gap, which simply means if everyone signed new leases tomorrow, that we would see an increase in rental income of just over 6%, which is about 30 million in an increase in dollar terms in income from rents, and discounted at our approximate weighted cap rate in the portfolio, that would be about 800 million in value for the apartment REIT. And obviously that doesn't happen over time. That's not going to happen tomorrow. So when we talk about potential value of 800 million, that would be realized over, say, the next year or two or further ahead. Like that's something that gives you good sense that there's some embedded value to be realized in the portfolio going forward.
Your leases, so I guess, when we talk about the market rent gap, you're going to bump up rents as people move out and new people move in. So are your rental terms annual, or how does it work?
Sorry, annual. What is when you sign a lease, you're in there for the full year. And then going forward, you have to give us, I believe it's 2 months notice if you want to leave after that 1 year term.
Okay.
So, yeah. But then, yeah, that's where you see and here's just a great example of some of our more recent acquisitions. And when I highlighted, these are very nice, middle income kind of B plus type of properties.
Yeah,
and
gorgeous.
they're actually, I know they look they look extremely nice, well run, great properties, amenities that people are looking for, and I do say this of a good size. The units are, and I say this because where I live in downtown Toronto, we were seeing, a couple of years ago, just increasingly the condos that were going for pre-sales were getting smaller and smaller. Just over 400 square feet, extremely small. Junior one bedrooms at like 415, 425 square feet. But these units themselves will be they're larger, better layouts, and with some very good amenities and obviously on-site operations. So again, very attractive for tenants and in good locations as well. Again, where people want to live. We want to be close to transit, close to shopping, close to some nightlife and, entertainment, whatever it is. So we want to make sure we're in the right locations.
Would some of these buildings that you have in the portfolio, or even in this slide, would they be like, multi-bedroom, or are they all single bedroom? How do they break out?
Oh no, they would be. I mean, there'd always be everything from a few bachelors for sure, 1, 2, and 3 bedroom units as well.
Wow. Okay.
And I'm saying you see more and more of those, just because more people are growing up in high rises, but also growing up in rentals. So if someone wants to move in and they know they're going to start to have a family, or they have young kids, they need the 2 or 3 bedrooms. So there's definitely more of those being built these days.
And I guess across the entire portfolio, like the portfolio has been around since 2004, was it? I think. And so, is it mostly newer buildings that you've kind of been buying as of late, but you still have a lot of older buildings that you've just updated over the years?
The fund itself, the apartment REIT we have today, has been around since August of 2009, and the age of the portfolio is roughly 13 years. So and I'll say over the last 5-6 years, all of our acquisitions have been brand new.
Wow.
And then, I mean, some of the older buildings, obviously we, renovate those, keep them updated, and make sure, again, they're efficient, but, make sure that they're, again, attractive places to live. But the portfolio itself it's very new. And you got this, you saw those buildings that we had recently acquired, and this is a great example of some of our student housing properties. Again, they're very new with the amenities that students want. And again, very location sensitive, especially the SFU. It's actually on the campus, but a different model there. But TMU one, same situations, right downtown, effectively on the campus, and the hub in Calgary, extremely close. So it's a very young portfolio overall. So we're very, very happy with how it's operating. And this, just very quickly, is capital, again, eligible for all type of investments here in Canada, qualified investors. And Iftikhar could always go over that with you, just to give you a sense of the qualifications, income-wise or net worth-wise, that you would need. Initial investments are $25,000, subsequent $5,000, distributions monthly. And again, if you don't need the income, which a lot of investors don't, you get the benefit of a 2% discount on NAV when you reinvest your monthly distributions as well. And there's different purchase options, but again, that's something that Iftikhar can always discuss with you. And we do have a performance fee, so fully aligned. Our management is with the returns for investors. They actually have to get a hurdle rate before there's any incentive payments made to the team. So it is something I think that fully aligns investors with investors with management, to make sure that they run one. Obviously, management gets paid when they do a better job. So I think that's what every investor likes to see.
And I don't know if that's the last slide, but I do have a couple of follow-up questions. Is this the last slide?
It is, yeah.
Okay. So I do have a couple of questions, just to sort of touch base on some of the points you had made. Can you just touch on public versus private REITs, performance, fees, etc., just in general?
I would say public versus private, the big difference is obviously just naturally comes with the volatility of the stock market. So, I mean, don't get me wrong, there's some very well run, good operators in the public space and the REITs that are listed on the TSX, but again, they're more subject to the whims of the public markets. So they will just naturally be more volatile than what you would see from something that's the Centurion apartment REIT, which is valued based off of fundamentals. Then what you avoid that stock market volatility. Yes, can reward you on the way up, but can be a little bit painful on the way down as well. So we're always saying, look, this isn't one, and you can always have some publicly traded REITs in there, but this is a very nice type of product to help stabilize. As you can see, it's been far lower volatility, far lower correlation to what happens in public markets.
Right. A big attraction for my clients have been where, they hear of, Bob down the street bought a condo a few years ago and it's gone up so much in value. So now they're thinking of buying a condo, and, they may not have the $250,000 to put down as a down payment. But I mentioned to them about Centurion. I go, look, why would you want to put all that money down and then have another mortgage and have to worry about tenants and so on and so forth? Whereas you can buy a piece of this particular portfolio and have something like this grow for you over a long period of time. And it's been, like a great winner for those clients that have been invested for a number of years, as you know.
Absolutely. And the REIT is, as you say, it's headache free. So you're not the one the tenant calls if there's an issue, say I don't know, washer and dryer break or whatever it is.
Right.
You don't have to chase someone down if they're not paying their rent. And I think a lot of people don't forget that. Obviously, the condo fees. If you own a condo, you got to pay the condo fees. The tenant doesn't pay that, and obviously the cost of the mortgage. And as we've seen, the values of condos are not going up as they were. There's always there was a negative carry on condos, but you know what? It was appreciating in a fairly good clip. So you would be slightly underwater every month, but the appreciation was more than covering that. Not anymore. So it's not as easy as it sounds. And definitely it's not that surefire way to riches that people used to think it was, which I don't know if it ever really was. People always seem to forget all the other issues that can come with ownership.
Absolutely. All right, Matt. So I think we're going to wrap it up here. I'm just going to share back my summary slide here. I am a Parvis Dealing representative. If you want to explore the strategy, please please get in touch with me. Otherwise, thank you very much for your time, Matt, this afternoon, and we'll talk soon.
My pleasure. Great to see you again, Iftikhar. Take care.
Take care.